Welcome to INVESTR, where we unravel the secrets of smart investing. Today we're embarking on a captivating journey through the world of Warren Buffett, the legendary investor known for his unparalleled success. We're delving into 12 common investment mistakes that even seasoned investors like Buffett have faced. And to keep things genuine, I'll share a few investment blunders along the way. Warren Buffett famously said, "It's good to learn from your mistakes. It's better to learn from other people's mistakes." So let's take this opportunity to learn from the master himself. Our exploration will highlight these errors and provide you with practical tips and strategies to avoid them. Understanding these pitfalls is crucial to navigating the stock market's choppy waters, whether you're a beginner or a seasoned investor. So buckle up as we dive into these 12 crucial investment mistakes and how to steer clear of them, setting yourself up for a more prosperous and financially secure investing journey. Number 1. Timing the market. First up on Buffett's list of investing errors is the tempting yet elusive art of market timing. Buffett and his partner Charlie Munger emphasize focusing on individual businesses rather than attempting to predict market movements. Even Benjamin Graham, Buffett's mentor, occasionally fell into this trap. The allure of timing the market is understandable. It's like trying to catch the perfect wave. You pick a fantastic stock and suddenly a crisis like COVID-19 hits, or interest rates and inflation soar due to geopolitical tensions. Naturally, you want to buy low and sell high. Sounds simple, right? Well, here's Buffett's golden nugget of wisdom. Focus only on what is important and knowable. Predicting market directions is essential, sure, but is it knowable? Can anyone truly foresee the next Federal Reserve decision, or of the myriad other factors influencing the market? Buffett suggests a more practical approach, identifying superior companies at reasonable prices. Recognizing a solid business is more straightforward than forecasting every potential economic storm. There will be challenges, but betting on the best boats should pay off over time. Number 2. Getting attached to your purchasing price. The second mistake is becoming too attached to the price you paid for a stock. Imagine 3 investors, Arnold, Ben, and Katie, who bought Amazon at different times, resulting in varied returns. Arnold feels good about his recent 5% gain, Ben is down 38%, and Katie enjoys a 133% return. But should these past purchase prices affect their current decisions about the stock? Buffett advises treating investment decisions as if starting from a blank slate. The market doesn't care about your purchase price. It treats all investors equally going forward. Whether you're up or down on a stock, what truly matters is its future performance, not its history in your portfolio. This mindset helps avoid emotional decisions based on past prices and encourages a rational focus on a stock's potential. Remember, the stock market is forward-looking, not backward-gazing. Number 3. Aggressive growth projections. Buffett warns against falling for companies' overly ambitious growth projections. Getting caught up in the hype is tempting when a company promises exponential growth, like 15% per year. However, such high growth rates are scarce, especially for large companies. Consider the example of thinking a stock is pricey now, but will become a bargain with continued rapid growth. This mindset can lead to risky investments in highly valued companies banking on aggressive growth forecasts. Buffett prefers investing in companies capable of growth, especially those requiring little capital. But the key is to avoid the growth at any price mentality. When you buy stocks at high earnings multiples, you're betting on substantial growth to justify your investment. Yet only a fraction of companies achieve such high growth. The takeaway? Be cautious of high growth promises, especially in today's market where companies like Tesla, Intuit, and Nvidia are the darlings of high expectations. Number 4. Using a lot of leverage. Another critical mistake Buffett highlights is the excessive use of leverage. It's akin to financial Russian roulette, taking a high-stakes risk that could lead to catastrophic losses. Leverage magnifies your potential gains, but it also amplifies losses. In the worst-case scenario, it can wipe you out completely. Buffett emphasizes that leverage can make even the most intelligent, disciplined investor vulnerable. The danger lies in being unable to hold on to your investment in turbulent times. Take the case of Harry, a hedge fund manager who decided to short GameStop using leverage. Despite having a solid initial position, the rapid increase in GameStop's stock price led to successive margin calls from his broker. Ultimately, Harry had to close his position at a substantial loss. Even though his analysis might have been correct, the use of leverage forced him to exit prematurely. This story illustrates the dangerous nature of leverage. It's not just about being right in your investment thesis, it's also about being able to withstand the market's volatility. Leverage can deny you the chance to see your predictions play out, leading to losses instead of profits. Investing is a marathon, not a sprint, and leveraging is like running this marathon with a heavy, unpredictable burden. So before we delve into the following insightful investment lessons from Warren Buffett, take a moment to hit that like button, subscribe to INVESTR, and ring the notification bell. This way, you'll continually be updated with valuable investment insights and strategies. Now, let's dive into more of Buffett's top investment mistakes. Number 5. Missing the forest for the trees. Buffett's experiences teach us the importance of not getting lost in the minutiae when making investment decisions. He believes that acquisition mistakes are usually not about the small details, but about misjudging the future economics of the business or industry, management quality, and price. These three elements are critical. Buffett's ability to make swift decisions is not just due to his vast experience, but also his preference for simplicity. He focuses on these vital areas rather than getting bogged down in every tiny detail. This is something I grapple with. For instance, I spent over a month analyzing various stock market companies, which took away time from creating content for you. However, I've learned to use a bottom-up approach, delving into details and summarizing the crucial points. For example, when analyzing a company like Nobia, I rate key aspects like growth, business, and management, while also considering cash flows and potential yields. Focusing on the big picture after a detailed analysis helps identify the best investment opportunities. Number 6. Jumping over 7-foot bars. Buffett and Munger prefer simplicity and clarity in their investments rather than tackling overly complex problems. They liken investment to stepping over a 1-foot bar rather than attempting to jump over a 7-foot one. This investment world doesn't reward unnecessary complexity. Success in investing often comes from straightforward, understandable businesses. The fallacy that more complicated challenges yield better rewards doesn't hold in investing. Complex mathematical models or predictions about future industry trends are often unrewarding and can be disastrous. The collapse of long-term capital management, led by mathematical experts and Nobel laureates, is a testament to this. The key lies in finding businesses with favorable prospects, trustworthy management, and reasonable valuations. In the world of investing, simple ideas often lead to extraordinary results in the long run. Number 7. Shrinking your universe of opportunities. Buffett believes it is a mistake to limit your investing options. At Berkshire Hathaway, they have the freedom to explore any investment that seems logical and avoid those that don't. This open-mindedness is crucial in investing. Just like in fishing, where staying too long in a non-yielding spot is unproductive. Clinging to a single industry or sector can be limiting in investing. Opportunities in the market are dynamic. They don't stay in one place. For instance, some funds specialize in areas like ESG, high dividends, or specific regions, narrowing their scope. While this may help market their funds, it's not necessarily aligned with where opportunities may arise. Initially, I almost fell into this trap when creating this channel, considering focusing solely on the gaming industry. While expertise in one area is good, being overly narrow can make you miss other lucrative opportunities. People drive the stock market, and opportunities often arise where least expected. Number 8. Staying active all the time. Buffett cautions against the need to make investment moves constantly. It's not a business where daily action is required or even beneficial. Think about it. Who is more likely to succeed? A tennis player who plays 5 games every day or 5 games yearly? Or an author who writes 5 times a week versus 5 times a year? In investing, often less is more. The key is to wait for the right opportunity, the fat pitch. You can't find a deal like Coca-Cola at a fair price daily. Markets fluctuate. Sometimes they're full of opportunities, and other times they're barren. And occasionally, opportunities might be outside your circle of competence. The beauty of investing, as Buffett notes, is that you can't strike out just by waiting. You don't have to swing at every pitch. Wait for the perfect one that fits your criteria. This approach reduces mistakes and leads to more fruitful investment decisions. Number 9. Diversifying too much. Buffett highlights the potential pitfalls of over-diversification. His philosophy is straightforward. If you genuinely understand businesses, you shouldn't need to own more than 6. Investing in your 7th best idea rather than adding to your top pick is unlikely to yield better returns. As Buffett puts it, people rarely get rich off their 7th best idea, but many have thrived on their top one. The debate on diversification is ongoing. If you're not inclined to regularly research individual companies, broader diversification, like owning an index fund, is advisable to protect against limited knowledge. However, suppose you're an engaged, know-something investor, familiar with specific businesses and industries. In that case, leveraging this knowledge can lead to above-market returns. Adding mediocre investments to an already strong portfolio can dilute its overall effectiveness. For transparency, I currently hold 10 stocks. However, the ideal number for diversification continues to be a topic of debate among investors. Number 10. Confirmation bias. Buffett and Munger both acknowledge that confirmation bias is a common and costly mistake in investing. It's a natural human tendency to interpret new information in a way that reinforces pre-existing beliefs. Munger humorously compares the human mind to a fertilized egg, which shuts off after one sperm enters, preventing any others from getting in. Investors must actively challenge their assumptions and consider contrary viewpoints to combat confirmation bias. I've found 2 methods effective: the darling-killing funnel and the bear pill. If you plan to hold 10 companies in your portfolio, start with at least 20 viable candidates, dedicating time to research each. This approach forces you to make tough choices, enhancing rational decision-making. The bear pill involves deliberately seeking out potential drawbacks of an investment or having someone play devil's advocate. This method ensures a more balanced view of each potential investment, helping to overcome confirmation bias. Number 11. Following the herd. One of Buffett's key insights is avoiding the herd mentality. Human behavior tends to be cyclical. People often become fearful or greedy en masse. Buffett and Munger have a distinct edge in this regard. They don't get swept up in the frenzy of others. Investing, unlike many aspects of life, benefits from contrarian thinking. In social situations, if everyone approves of something, it's genuinely a positive sign. However, widespread agreement on a stock might be a red flag in investing. As Howard Marks astutely observes, what's clear to the broad consensus of investors is almost always wrong. The danger of herd mentality is particularly acute when seeing others, especially close friends, making easy money. It's a trap I fell into by investing a significant amount in a startup outside my circle of competence, simply because a friend had seen success with it. While the outcome is still uncertain, it is a potential major mistake influenced by following others. Number 12. Omissions. Buffett considers omissions, opportunities missed due to inaction, his most significant mistakes. These are the moments when the right decision was clear, yet hesitation prevailed. For instance, Buffett regrets not investing in Fannie Mae when it was struggling, a decision that could have earned Berkshire billions of dollars. Similarly, he almost missed investing in one of his most significant ventures, See's Candy, due to a fixation on a lower price. These omissions often stem from getting overly attached to a specific purchase price, as was the case with Walmart. Buffett initially found its stock attractive, but hesitated to buy when the price slightly increased. This decision cost Berkshire approximately $8 billion in potential profits. The lesson here is clear. When you identify a fantastic opportunity within your competence, don't just nibble at it. Take a full bite. These are Buffett's 12 deadly sins of investing. Do you have another mistake to share or a personal investing experience that others could learn from? Well, please share it in the comments to help your fellow investors. And if you're interested in more insights from Warren Buffett, including his most important investments, check out our videos. If you found this video helpful, please like, subscribe, and share it with others who might benefit from these lessons. Cheers, and here's to smarter investing.